All right. Thank you, everybody, for joining us today. My name is Matthew Donovan, and I'm head of rig market research at Esgian. And today we'll be doing our webinar, Navigating Rig Values in a Volatile Market. So joining us today to present at the webinar, we have our senior analysts on our rig analytics and rig values team, Bartolomeo Tomic and Sofia Forestieri. And as a note to all of you, a lot of the data analysis you'll see today is available in our databases, Rig Analytics and Rig Values, which have information about the rig market. And for rig values, we have information on rig sales and valuations. So we're going to be starting our presentation momentarily. We will try and leave some time at the end for question and answer session. So if you do have questions, please submit those via chat or Q&A, and we will try and answer some of those at the end. Any that we don't get to during the presentation, we will reach out personally to you with answers to those. So again, thank you very much for joining us today. And I will now be passing over to Bato Tomic to begin our presentation. Thank you all.
Thank you, Matthew. Good afternoon, everyone. My name is Bartolomeo Tomic, a senior analyst at Esgian. As my colleague Matthew mentioned, I'm joined by Sofia Forestieri, also a senior analyst, and together we'll walk you through the current state of rig transactions and rig values in this volatile market. Our session today will focus on the key trends shaping 2024, insights on recent rig sale counts, and long-term outlook for the offshore rig values. Here's a quick look at what we'll cover today. First, we'll review key market drivers and trends in 2024. Then we'll delve into actual rig sale counts and how our valuation methodology works. We'll also explore the impact of market volatility on rig values, followed by a discussion on why rig earnings don't always align with day rates. Finally, we'll look at long-term outlook for the rig market, including the shrinking global fleet and potential for future values growth. Next slide, please. To begin, let's look at the current situation for rigs in 2024. This year, rig sales have lagged behind previous years, partly due to the suspension of 27 jackup rigs by Saudi Aramco. While sale activity has slowed, we're still seeing some momentum through M&A deals where we saw Noble acquire Diamond Offshore, bringing the total rig transaction count above the whole 2023. So 24 so far has seen increased rig count transaction compared to last year. We believe that Diamond's focus in the transaction was the Diamond's drill ships as opposed to semis, which are a bit older, and we expect at least 2 of those to leave the market near term and be sold for recycling. Currently, we see 27 rigs under construction. It's important to know that these were ordered during prior market upcycles. While we are in an upcycle, as you can see in the utilization chart on the right, we don't expect new build orders anytime soon because these face high costs and long lead times. And for example, if you would like to order a high-end drill ship, new build drill ship today, you would need at least $1 billion and 5-year lead time and day rates of 800,000. It's hard to imagine this will happen anytime soon, if ever, because we've seen day rates going above 600,000 recently, but this is not a rule yet, and it's hard we'll see 800,000 ever. So for harsh environment semi, we can expect to pay $1 billion to order a new one, and it would require a high day rate of above 700,000 and a long-term contract. For new build jackups as well, you would need more than 300 million and a high day rate with a contract of more than 7 years in advance of the ordering of the rig. So with these high new build prices, we see companies that want to high grade their fleet, favoring mergers and acquisitions or purchases of stranded assets that are already in the shipyards and built to some extent. We've recently seen Seadrill showing interest in expansion, either through acquisition of distressed assets or potentially as being a junior partner in a larger merger if the price is right. Transocean also said recently that there might be a potential for one big consolidation. Next slide, please. So when it comes to rig sales counts, in the reporting period, which is early 2018, 2018 itself was the strongest year for sales across all rig types, with a total of 102 rigs sold. 2023 marked the lowest point with a sharp drop with only 28 rigs sold. This year, 2024, showed a slight recovery, has shown a slight recovery compared to last year in the number of transactions, but it was boosted by that said Noble Diamond merger. Jackup sales are at the lowest point this year. When it comes to rigs sold for recycling or conversion, jackups dominate the recycling and conversion sales in most years, particularly in 2018 and 2021. For semis, sales for recycling and conversion peaked in 2020 with 19 semis, either recycled or converted. In 2024, semis were the only rigs sold in this segment, with 10 units leaving the market and 0 jackups and drillships sold for recycling or conversion so far this year. Drillships have seen limited recycling conversion activity, with most recycling and conversion sales occurring in 2018 and 2021 period, simply for the fact that these are the youngest rigs in the fleet and the most capable rigs in the fleet, so owners are not really looking to scrap any of high-end units. Next slide, please. There are 79 rigs that have been stacked for more than 1,000 days. Of these, 38 are jackups that were built 1968 to between 1968 and 2000. The decision to recycle these rigs depends on several factors, including their location relative to recycling facilities and their size. The longer these rigs remain stacked, the more likely they are to be considered for recycling and scrapping. However, it's important to note that these 79 rigs are all owned by 34 different owners. So the fact that there are so many different owners might slow down decision making, and by this the attrition rates. Some owners may not be in a hurry to recycle rigs, especially if they're holding out for a market recovery or waiting for better economic conditions. Also, jackups typically have lower recycling value, and depending on where the rig is located, one might need to lose money to recycle it, as the mobilization to a recycling yard can be higher than the rig's steel value. Thank you. Next slide. Now we move to new rigs entering service. Since 2018, the highest number of new build rigs entering service occurred in 2019, with 26 rigs delivered. In 2024, we've seen 8 new rigs entering service so far, comprised of 3 drillships and 5 jackups. Borr recently took delivery of the Valley jackup. Eldorado took delivery of Zonda and Dorado drillships. Near term, Borr will this year also take delivery of the VAR jackup, and Eldorado recently secured financing for the West Draco drillship too, so we might see that rig coming into market soon. Interestingly, just last night, a contract was awarded to Hanwha Drilling's new build drillship Tidal Action. Worth noting, because we already mentioned that there would be no new build orders soon. These drillships that we've mentioned were all actually originally ordered in 2013 and then abandoned. So these were stranded rigs waiting in the shipyards to be acquired. Thank you. Next slide. Now let's move to our Esgian valuation methodology. At Esgian, we use a comprehensive methodology to estimate rig values, incorporating multiple factors to arrive at a fair market value. Our approach includes analyzing macro trends such as the Brent oil price, historical pricing, and oil company spending patterns. We also consider rig market fundamentals, including supply-demand dynamics, utilization rates, and contract backlogs. We also look at recent transactions, the technical condition of the rig, factoring in type, age, operating environment, and current operating status, whether the rig is drilling, warm stacked, or cold stacked. Also, when we value rigs, we value them as a non-distressed asset. So, for example, in our system, you might see that a rig has been sold for less than what we had valued it, because the buyer might have been a distressed company that needed quick cash and to pay for debt or something, so they might have sold it for cheaper than the rig's actual worth, so they were pressed to sell it. So ultimately, we combine all these inputs to assess the rig's fair market value. That would be all from my side. Thank you for your attention. To delve deeper into these market factors and to provide insights into the outlook for the coming years, I'll now hand over to my colleague, Sofia Forestieri. Sofia will explore the long-term projections for rig supply and demand and discuss how shifts in the global energy landscape may impact rig values and day rates moving forward. Sofia, over to you.
Thank you, Bato. Yes, so I am Sofia Forestieri. I'm also an analyst here in the offshore rigs team at Esgian. And I start my presentation today, like the second part of this presentation, analyzing three very important metrics. So implicit values, rig values, and day rates. And the focus on this slide is going to be for 6th-gen harsh environment semis and 7th-gen drill ships. We start by looking to the chart on the left, and here what we have is implicit values from Pareto Offshore in dark blue from a selected pool of drilling contractors. In light blue, we have rig values for the rigs that those companies own, and the data comes from the Esgian Rig Values database. We here also have this metrics for June and August 2024. So a few things that are interesting here. When we compared the implicit values from June to August, we see that they have declined significantly, except for Transocean. Now, when then we look at the rig values for the rigs that those companies own, we see that the case is a bit different. First, the rig values, they remained stable from June to August. And also, in most cases, they are actually higher than the implicit value for the company. Now, when we move to the right, we here analyze day rates for contracts that were fixed since January 2023. Here, the trend is completely different. When we have the average day rate from 2023 compared to the average until September 24 has increased 21% for drill ships and 11% for semis. So what does this mean? This indicates increased demand and potential revenue growth for offshore rigs. And us here at Esgian, we believe that this upward trend will continue through the decade. Also, when we compare those three metrics, we see that there is a misalignment between values and day rates. And this may indicate, for example, that short-term trading may not be reflecting this company's true value or their true earnings potential. And also, this could mean that there is an opportunity for strategic investments in offshore drilling. And this is aligned, as we've seen, with the rising day rates, which, again, create a higher earning potential. Now, with this optimistic view, we start the long-term outlook part of the presentation, where we show the offshore rig market in a changing world. Here we're going to set the scene very quickly, and we start doing that by looking at the future oil demand by the lenses of IEA and OPEC. So here we look at their key assumptions behind those the forecasts for the oil demand, and we are presented with completely different views of the future. It's just like living in two different worlds. These key assumptions, they diverge greatly. And one example is IEA assumes fossil sunset, so scaling up of clean power would happen coal, natural gas, and oil, while OPEC assumed that the energy policies that we have today, for example, the switch from internal combustion engines to electrical vehicles, won't be realized in the given timeline. Then these assumptions, they lead us to the chart that you see on the left. For this chart, to create this chart, we use the assumptions, the points, the numbers in time that both entities have given us, but we also used a simplistic linear approach to show how the curves would behave all the way into 2050. And from this chart raises a question: what kind of future does Esgian believe would be the most likely to be realized? So where do we stand? And we stand, the Esgian view, we're in a place where we like to call the intersection where IEA and OPEC meet. And where is that? In the chart, it's exactly where we see the IEA steps scenario in gray and the OPEC advanced technology scenario in light blue overlapping. And what are the assumptions behind those two scenarios? They're assuming a gradual phase-in of fuel replacement and new technologies, as well as global scale electrification requiring large amounts of energy. What does that mean? That means the need of fossil fuels in the coming 20 to 30 years. So having set the scene now, we start analyzing the long-term outlook with supply. So we know that the global rig fleet has shrunk, but how about the actual competitive fleet? So here in this slide, we're putting into perspective the total competitive fleet compared with the total supply. And what is total competitive supply for us? So those are the rigs that are available for work in the year in question. And how do we calculate that? So competitive supply is the total supply, all the rigs globally, minus rigs that are under construction in the specific year, minus the rigs that are uncompetitive. Uncompetitive rigs are the long-term cold stacked rigs, stranded assets in shipyards, operator or state-owned rigs, as well as sanctioned rigs. Now, when we go back to the chart and we look at this competitive supply broken down by rig type, there's a very interesting outcome. So for drill ships, when we compare the competitive supply in 2018 with 2024, we see that there has actually been a 20% increase. For jackups, we see that there has been an 8.3% increase. And for semis, the case is actually different. There's been a 32.4% decrease. And what could be the contributing factors for this? So, for example, jackups and drillships deliveries, they have outpaced the attrition, and this is something that it was mentioned by Bato in his presentation. For example, the drillships are a newer, modern fleet, so and as well as semis, they're most likely candidates for attrition given the amount of steel that they have compared to jackups, and of course, this drove the increase in supply. Also, we are already seeing in the past few years, especially since the beginning of last decade, that there has been a market shift and there has been a rise in deep water operations and high spec operations. And this drove a boom in drill ship deliveries in detriment to semi deliveries, which were in the last 15 to 20 years the preferred floater type for operations. And also, as mentioned a few times already in this presentation, there is this new sentiment in the market for no new rig orders being expected across all types, jackups, drill ships, and semis. And this could significantly impact the future supply. And it's exactly what we're going to see next here. So here we have analyzed and made a supply forecast for the next 2 decades, and that's the chart on the left. So what were the key points behind this? So again, we're assuming a global rig fleet shrinking, so few new builds and continued fleet attrition. We're also assuming that all deliveries for floaters and most jackups would happen by 2030. And when it comes to attrition, we're assuming a continued attrition expected as we have 61 rigs stacked for over 1,000 days with SPS either lapsed or due in 2 to 3 years. Now, from this, using this supply and the oil demand scenarios, EIA steps, and advanced technology that we previously saw, we have also made a rig demand forecast, which are the curves in red and green. So what does that show us? That shows us that there will be a healthy demand for rigs in the coming 15 to 20 years. And from this demand and supply, we were able to calculate and forecast utilization as well. And we see that utilization could be as high as 90%, and which means we'll be in a tight market. Now, these high utilization rates, which are expected, they would be drivers for higher day rates and higher rig values in the coming years. And again, we're seeing a market shift. So there's been a shift from speculative orders to strategic investments. And that is for companies to ensure sustainable growth and resilience in the volatility that we see that our industry has and has been having in the past years. With all that, what could day rates look like then in the long term? Here we have the forecast for day rates for drill ships, 6th gen and 7th gen. We also have for the harsh environment rigs, NCS compliant semis and NCS compliant jackups, as well as for 6th gen international semis and premium jackups. So day rates for drill ships and jackups, they remain strong, as we can see this decade, and they have the potential to increase even further into the future, with a decline beginning towards the middle of the next decade. Also, even though we have an aging semi-fleet, there is a strong demand for harsh environment units, especially as it is a tight market, and that combination could actually push day rates higher for semis. And that's also what we're seeing in this slide. And also, when we look at the 7th generation drill ships, we see there are higher day rates for those types of rigs. And this highlights this market shift, this growing tendency for more advanced, more modern units. And this positions those rigs as the core of fleet upgrades, of the core of the company's rig fleet. And those higher day rates, they are one of the factors that, a very important factor, that contribute to the rising and stable rig values in the next 2 decades, the same period. So from this presentation, what we're seeing from this long-term outlooks is that the offshore drilling market could experience stable growth, as mentioned, without significant oversupply. And here we have what we call this higher for longer conditions for day rates and rig values, and fewer new rigs continue to support those rising rig values. And what we expect that could happen is those rig values reaching levels close to seeing before the downturn, and that would be by 2035. With that, we are coming to the end of our presentation. But before we move into the Q&A, we want to leave you with some key takeaways, some main points and messages from our presentation. And we start by saying that rig values, as we've known and seen, have experienced fluctuations due to the market volatility, and that is particularly influenced by regional shifts. For example, the Saudi Aramco suspensions earlier in the year, also oil price uncertainties, as we're seeing right now, and geopolitical factors. Also, even though in 2024, like so far this year, we have seen fewer rig sales, the Noble Diamond merger has elevated the total number of rigs changing hands. That is signaling that strategic consolidations are being preferred over individual rig sales. Also, high capital costs and long lead times for new build rigs make acquisitions of stranded assets and M&As a more viable option in the current market, and that the focus has shifted from the speculative orders in the past to strategic investments, with companies like Seadrill and Transocean exploring consolidation opportunities. With fewer new builds expected and continued attrition, rig values and day rates could rise through the decade and beyond, and of course, favoring the modern high-spec rigs. And finally, the rig market will tighten in the next few years as forecasted utilization nears 90%, and the drivers behind are high demand and continued fleet attrition. I thank you very much, and I pass over to you, Matt, for the Q&A.
Well, thank you very much, Sofia, and thank you, Bato, also for the presentation today. If you do have questions, you can submit those through the meeting chat, but we do have a couple of questions coming in that I think we can address. So number one, would you say, this question here is, what role do stacked rigs, I mean, particularly those rigs that have been stacked for a longer period of time, play in the future supply dynamics of the market?
I can take that one. So, Matt, the stacked rigs, especially those that have been idle for a long time, they do impact very much the future supply. And as we've seen, we're talking about a tight market. So reactivating these units could provide a quicker, more cost-effective way to meet the new demand, the healthy demand that we just saw, compared to new builds. As Bato presented, they require large amounts of investment, and we also know that there's a long lead time. So it's not a fast process when it comes to new builds. But also we need to keep in mind that we have reactivation costs, and we have to look at the condition of those rigs after a long stacking period, because they could be main challenges. But
Right.
with continued growth in demand and this new build halt, stack rigs, they could be essential for fleet expansion to meet the demand in the future.
All right, thank you. We've got another question coming in on the chat. How much has Aramco's suspensions, have they impacted jackup day rates now being negotiated?
I think I can take that one as well.
Yeah.
Yeah. So what we have seen is that most of the rigs that have been suspended, they have secured work, not in the Middle East, but also outside. And what we have
Yes.
seen is that initially what was expected is that we would see a drop in day rates, but that's not what happened. We have seen, for example, rigs moving from the Middle East all the way to Brazil recently, one of the Bor rigs, and with a day rate that was much higher than the contract that they had with Saudi Aramco. So this is giving the rigs opportunity to actually secure short-term to mid-term, not short-term, like short time to mid-time contracts with actually competitive day rates.
Yeah, I think that's true, Sophia. And I said, well, we have definitely seen some, particularly in sort of the early part of the suspensions, we did see some contracts fixed at, what I would say is below a general market value. But a lot of the premium jackups that were put on suspension, I said, have kind of secured work already, as you mentioned. And so when you look at the number of rigs that were suspended, versus the market as a whole, and jackup utilization still does remain quite tight. So while it has had a little bit of effect on day rates, yes, we have seen some units definitely secure higher rates than they were working at before. So it's not had it's definitely caused some uncertainty in the market, and has been a factor in negotiations. It's not caused a massive dip in day rates on that. Let's see. I think we've got, Will said, if we don't get to your question during this, because we are coming up at the end of our time, we will also send out emails to you with responding to those questions. And we will also have this presentation available on as a YouTube recording later in the week. So a question here is, what drove the high rig sale count in 2018?
I can take that. Thanks,
Yeah.
Matthew. The surge in rig sales in 2018 was largely driven by an increase in rigs sold for conversion and recycling. So you can see that in our chart that
Yeah.
nearly half of transactions were sold in for these purposes. So 32 rigs were sold for recycling and the rest for conversion. A significant portion of these transactions involved bore drilling and what used to be called Paragon. Bor's acquisition of Paragon's fleets resulted in a number of units being sold for either recycling or conversion, while Paragon itself offloaded some of its rigs for scrapping before the Bor transaction took place. Also, 2018 was the year when Transocean bought Ocean Rig and its drillship fleet, and Bor also purchased new builds from Keppel at the time. So these larger deals, combined with several individual sales by other players, made 2018 a record year for rig transaction count in the reported period.
Right, that makes sense. So yeah, I think you're right. Is especially in 2018, we were kind of 4 years into the downturn by then. So what we were seeing is a lot of stacked lower spec units were being sort of sold off at that point, especially in the jack-up market. All right. I think we're running to the end of our time now. So everybody, if we did not get to your questions, we will reach out personally on those. And to everybody else, I said yes. I think we will have a recording of this available and slides available if requested. Again, thank you for joining us at Esgian, and data from these presentation can be found in our rig values and rig analytics databases. So once again, thank you for joining us, and thank you to Bartolomeo and Sofia for the presenting today. Thank you all.
Thank you.
Thank you.